Welcome to the SWIB Podcast, where members of the Wisconsin retirement system can turn for timely information on the investments that help fund the state's pension system. I'm Chris Preisler, Communications Specialist for the State of Wisconsin Investment Board, or SWIB.
And I'm Dusty Weiss, producer of the podcast.
SWIB has implemented a diverse and sophisticated investment strategy for the Wisconsin retirement system, or WRS. The core trust fund, the larger of the two WRS trust funds, holds investments in public equities, fixed income, real estate, and private markets. That investment strategy also includes a mix of active and passive strategies. In this episode of the SWIB Podcast, we're going to focus on the role passive strategies like synthetic replication, passive exposure management, and leverage implementation have in helping keep the WRS fully funded. We'll also learn about securities finance, collateral optimization, and liquidity management and how they benefit the trust funds. Finally, we'll hear how SWIB helped with the founding of the Global Peer Financing Association and how it helped SWIB engage in a variety of securities finance activities and promote best practices and knowledge sharing with peers across the world.
The SWIB Podcast is a regular opportunity for you to learn more about the people and trust funds that comprise the Wisconsin retirement system and SWIB, the state agency responsible for managing the retirement system's more than $155 billion in assets for over 677,000 participants. Please make sure you subscribe in your favorite podcast app so you don't miss an episode. Share this podcast with your fellow WRS members, and leave a review on Apple Podcasts so it's easier for other members to find this show.
Joining us is Chris Benish, a senior portfolio manager in the Asset and Risk Allocation Division at SWIB, where he's worked for over 17 years. He oversees synthetic replication, passive exposure management, and leverage implementation. He also focuses on issues related to securities finance, collateral optimization, and liquidity management. He's a founding member and serves as treasurer of the Global Peer Financing Association. Chris earned his bachelor's degree in communications and media studies and his master's of business administration from the University of Wisconsin-Madison. He's also a chartered financial analyst charter holder. Chris, welcome to the SWIB Podcast.
Thanks for having me.
Now, Chris, you earned your degree in communication and media studies. How did you wind up working in the financial industry and at SWIB as a portfolio manager?
Well, it was a bit of a journey. So my first job out of undergrad was as an academic advisor at the University of Wisconsin-Madison. At the time, I was working with business undergrads, helping them figure out what they wanted to do and what they wanted to major in. One of the pieces of advice I'd often impart on them was don't worry so much about your major. Think about kind of the whole person that you bring, right? What are you doing outside the classroom? What are your practical experiences that you're accumulating and really trying to make positive contributions? While I was an advisor, I also got an MBA, and shortly after that, landed at SWIB working in securities finance. Turns out I found the work really fascinating, and I tried to do what I could to learn as much as I can and make some of those positive contributions. I really tried to take advantage and follow my own advice to the extent that I could. I looked for ways to contribute. I leveraged my communication skills and really tried to build a career out of networking and sharing ideas with other coworkers and other organizations. Over the years, I've had a few different roles at SWIB, but kind of the theme running through them is really looking for ways to contribute and advance what the organization is trying to do. I like to think I embrace change and look to solve problems and have grown with the organization. And I've really been lucky, I think, to be a part of a number of different key initiatives that SWIB has undertaken in my time here. That includes our use of derivatives and how we look at leverage in the market.
So in your role at SWIB, you oversee synthetic replication, passive exposure management, and leverage implementation. You also focus on issues related to securities finance, collateral optimization, and liquidity management. That seems like a lot, but you're really focusing on passive strategies within the overall investment strategy for the WRS, correct?
Yeah, passive investments is certainly a big part of what I and my team does. I oversee a really great team responsible for most of the passive strategies of the WRS. But if we step back, when I think about where passive investment fits within the overall investment structure, one of the great benefits of a fund like the Core Trust Fund is the different strategies that we have access to. It's a really diverse group of asset types, a really diverse group of strategies. And that really begins with our asset allocation. The asset allocation is determined by our board, and that sets the tone and sets the strategy for which asset classes we're investing in, how much of those asset classes we're investing in, and the breadth of assets that we're investing in. That overall asset allocation gives our investors access to a lot of different asset classes and strategies that wouldn't otherwise be available to an individual investor, things like private equities or real estate or hedge funds. Part of the diversification benefit comes from this active versus passive decision and where we invest in both. Now, when we look at an individual strategy, usually a strategy is measured against a benchmark, and that benchmark represents the universe of securities for a given sector or a given strategy. To take an example, if you wanted to get access to, let's say, large US equity companies, you might use the S&P 500 as your benchmark. That benchmark represents the 500 largest companies within the US and the equity of those companies. Now, an active strategy is going to seek to perform better than that benchmark by selecting securities. An active manager is going to hold more of the securities they think are going to do better and hold less of the securities they think aren't going to perform as well. A passive strategy, on the other hand, seeks to match the performance of that benchmark. We're not looking to do better or worse, but we're looking to give the fund exposure to a specific asset class or sub-strategy, often by holding the exact securities or proxies of those securities that are in that given benchmark. So in some ways, the passive strategies serve as kind of a backbone to a lot of the other investment structures and investment functions within the WRS. So these low-cost passive strategies really give us efficient access to the large allocations that we need to stay on target. For a pension fund our size, liquidity is key, and this really manifests in how we rebalance. So as I mentioned, the board sets the allocation targets, which are the target weights for each of the underlying asset classes or market segments that we invest in. And over time, those strategies grow at different rates and move away from those targets. So periodically, we'll rebalance. We'll sell assets to which we're overexposed, and we'll buy assets to which we're underexposed in order to bring us back in line with those predetermined targets. Now, passive strategies are an ideal vehicle for this because A, often the transaction costs are much lower in passive strategies than they are in active strategies. But B, by rebalancing through passive investments, we allow our active managers to focus on the very important work of seeking out the best investments. They don't have to deal with the cash flows in and out that come from frequent rebalancing back to targets. In part because of this, we tend to hold passive exposures to a wide variety of asset classes in order to facilitate that rebalancing.
So what is the motivation that drives SWIB's decision to seek out passive exposures?
There's really several factors at play here. Someone might ask, why wouldn't we always be active? Wouldn't we always want to try to do better than our benchmark? It's a reasonable question, but additional return often involves additional risk, and we manage our risks very carefully. We're looking at the trade-off between the active or alpha opportunities and those risks, but also the cost. There's times when the opportunity set for active management might be limited or it might be very expensive. And we have to weigh those with the overall job that we have, which is to put all of our assets to work. And so we're also sensitive about concentrating our risks. And so this diversification between active and passive is part of the way that we balance our concentration of risks. The diversification means taking lots of different risks in lots of different ways in order to balance them out. The passive allocations help us to stay on target with the overall allocation, but not incur excessive fees or undue illiquidity of having all our eggs in one basket, so to speak.
Now, let's talk about another one of the strategies that we mentioned here. Speaking as a layman myself, when we talk about the fact that you oversee synthetic replication, I'll be honest, I'm not exactly sure what that means. Can you explain what synthetic replication is and how your team uses that strategy?
Yeah, when we say synthetic replication, what we're really talking about are derivatives. And derivatives are a key tool that we use in order to manage our overall allocation. My team, when it's looking at how to invest in various passive strategies, we have a few different options available to us. We can run the strategy internally and hold the physical securities that are in the given index. We can hire an external manager to run a passive strategy for us, or we can use derivatives. Derivatives are just a financial contract that essentially gives us exposure to an underlying group of securities or an underlying index. Now, in some cases, the derivatives that we're using might be cheaper or more liquid than the group of underlying securities that it represents. And because we're focused on that trade-off between cost, liquidity, and accuracy, we're able to balance those risks when we decide, are we going to do this physically? Are we going to do this synthetically? Going back to the S&P 500 example, if I want exposure to large cap US equities, I could buy all 500 of the stocks that are in the S&P 500, or I could buy a single future or trade a single swap and get access to that same group of securities. The trade-offs here are the cost, the speed, and the liquidity, but also the accuracy, or what we call tracking error, how close that derivative matches the benchmark or the index that I'm trying to replicate.
I think you do a really good job there, Chris, setting the table with all the different tools that are at your disposal here. I did want to drill down a little bit deeper on one area that you mentioned, and that is securities lending. Can you talk about how SWIB started its securities lending program, which has a peer-to-peer component to it, and then built it up to the point where it's at today?
Yeah, so when I started at SWIB 17 years ago, I actually started working on securities lending. So the program is near and dear to my heart. At the time that I started, the program was quite simply a very low-risk way to add incremental income from the assets that we already own. The transaction works like this. We hold a variety of stocks and bonds across our fund. In the market, there are other market participants that would like to temporarily borrow those securities. They might be shorting a stock. They might be managing the settlement of trades that they have in the market. But for one reason or another, there's value to them in borrowing those securities. So we lend the security that we already own to the other counterparty. We receive collateral in return to ensure that we get our security back. And the net result of this is we make a small fee from the borrower on that transaction. Now, if we did this once, the fee is very minimal. We don't make a lot of money on a given individual trade. But given the size and the breadth of the securities that we hold across the trust funds, we can do this transaction thousands and thousands of times and earn meaningful income. Now, it's important to note that many institutional investors do engage in securities lending, and in fact, it's an important part of well-functioning markets. It not only facilitates timely settlement of securities and trades, but it also facilitates efficient price discovery because we're facilitating trading activity both on the long side and the short side. That helps price discovery happen for a given security and allows both buyers and sellers to meet and find the right price for a given asset.
Well, and I know that the intricacies of the market have really changed a lot just over the last generation here. So how has this program evolved over the last 17 years that you've been working on it?
Yeah, I've really seen two very interesting evolutions from my perspective. The first is the way that we use our collateral to facilitate our leverage and liquidity program within the core trust fund. So when a counterparty gives us cash as collateral, we can use that cash to fund other activities such as leverage. Because we have a large loan book and because we have a diversified pool of borrowers that are borrowing our securities, this becomes a really stable and low-cost source of borrowing for us. And it's really advantageous for us to use this cash for that purpose. The second big innovation is our self-borrow program. This allows our internal active strategies to borrow securities that we already hold, often in the passive strategies, rather than borrowing from a bank or a broker-dealer outside of SWIB. This internalization saves us a lot of money.
Like with any investment strategy, there's always challenges. What are some of the challenges that come with passive strategies and leverage?
Sometimes there's a perception that passive investing is easy. I would argue that what we do and what my team does involves a lot of precision across a lot of different indexes and strategies. While an active team might focus on one index or strategy, my team has over 30 portfolios with nearly a dozen different strategies, so we have to be efficient. Given the size of the exposures that we manage and the flows that we handle, if we get something wrong or we're out of alignment from our targets, a mistake adds significant unintended risk to the overall fund. I often liken our group to the offensive line in football. We're not going to be scoring any touchdowns, but we allow the other strategies to operate well. And if we're not functioning, then we can really dig a hole for the broader team. It's also challenging because of the scale that we operate at. And that challenge really comes down to liquidity. We're moving in and out of exposures pretty frequently and at pretty sizable amounts. And when we move in and out of those exposures, we want to do so without making waves or moving the market around unintentionally. So we really do a lot of work thinking about the instruments that we're going to use, the routes to market we have, and the strategies for a given purpose, whether we do physical or derivatives. All of these strategies that we're involved in, that my team's involved in, benefit from big, deep pools with lots and lots of participants. Now, this is different from an active manager that might have a very unique proprietary investment process or investment analysis that isn't shared broadly. My team benefits from lots of people participating in these markets and trading. If we were to try to trade an asset with a very small investor base or a derivative that not many other people are trading, it's going to be much more difficult and more costly for us to achieve our exposure targets at the size that we need. And so trading off between precision and cost and liquidity helps us find that efficient sweet spot.
Is there a way to ensure sufficient liquidity?
We take a number of approaches, one of which is to seek out different routes to market. So we talked about using derivatives, we talked about using securities lending for leverage, but we also have other tools that we use, especially when we need to borrow, things such as repurchase agreements or repo. We're also looking at other tools and routes to market that we're continuing to evaluate and develop in our ever-evolving program. These different tools allow us to diversify those risks of borrowing and allow us to diversify how we get exposure to different asset classes. Similarly, we've worked really hard to build a diverse group of counterparties that we trade with for different trading and borrowing activities. So it's not just banks and brokers who we look at for best execution, but it's also other asset managers and even pension funds. That way, a problem or a disruption with a single counterparty isn't as disruptive because we can pivot to other counterparties before we have to unwind a given transaction.
I'm just going to be honest, Chris, that seems like an awful lot to keep track of, a lot of balls to keep up in the air. How do you manage such a big challenge for you and your team?
It's a challenge, but it's also a big opportunity. For an entity like SWIB, one of our biggest advantages is that we are a big pool of stable capital that we're investing. We have a lot of trust from our beneficiaries, and we value that trust really highly. Because of that trust, we don't have to worry about a so-called run on the bank like other investment managers might, like a hedge fund or a mutual fund. We're able to weather liquidity shocks that other market participants can't. We're able to maintain that long-term focus on our investment strategies that add value in the long run. And much of the work around these different passive liquidity management or leverage management activities are really focused on ensuring that diversity and that stability. I would say additionally, because we have a top of the house view on all of this, particularly on collateral, we can optimize. Across all of our different strategies, we deliver collateral for a whole wide range of reasons. Sometimes we're borrowing for shorting, sometimes we're borrowing for leverage, we're using derivatives. In each of these instances, we might be delivering collateral for different purposes. A lot of this activity is managed centrally and holistically, so we make sure we aren't delivering excess collateral, or we're not using assets as collateral that might be more valuable in another strategy. For example, we wouldn't want to deliver a security for collateral that has value through a securities lending transaction. Instead, we optimize, we deliver something that has less value elsewhere in order to get the best economic outcome for the fund. I would also say that because we're active participants in these funding and derivative markets, we're able to better recognize when illiquidity pops up. We're able to recognize when the market presents opportunities, and we know what a good deal looks like. We know how these things should be priced. Across the variety of strategies that we run, and because of the network of counterparties we've nurtured, we're in a position to react to market liquidity by borrowing when costs are low and lending when costs are high. And that's just another way that our emphasis on internal management adds value to the WRS. Again, this holistic management of leverage, liquidity, and passives, it allows us to remain fully invested and on target, but yet nimble enough to manage around the various risks of the market. And that's no small feat for a fund as large as the Core Trust Fund.
Chris, you mentioned trading with other pension funds. Can you give us some examples of peer-to-peer transactions that SWIB might be doing?
Yeah, this is something I'm really passionate about. When we look across the investment landscape, there are a lot of different market participants out there. Banks and brokers are beholden to their shareholders. Hedge funds answer to their investors. A pension fund like SWIB, we're fiduciaries to our beneficiaries. And like SWIB, other pension funds have a whole variety of lending and borrowing needs. Over my years at SWIB, I've interacted with some of the more sophisticated pension funds out there. And what I found is a lot of times their needs align with our own at different times. Pensions, like many participants, use banks or brokers to intermediate a lot of the trading activity that we do. And those brokers have to eat, so they build in some fees in order to facilitate those transactions. By trading directly, sometimes we're able to eliminate the middleman and pay less than we would otherwise. So while a bank might charge a higher fee to lend over a quarter end, a pension might be more interested in a more stable, predictable loan balance year-round. Now, we don't trade with pensions in all instances, but where we do find those efficiencies, we're able to reap the benefits and diversify our counterparties at the same time.
So where is SWIB engaging in these peer-to-peer transactions?
To date, we primarily engage through the repurchase agreement markets or repo markets. Like sec lending, a repo transaction is where we're borrowing cash and providing securities as collateral. And in those markets, we have actually several active trades with other U.S. pension funds. We also borrow securities from our peers if we aren't able to source them internally through our self-borrow program. Now, that's facilitated by an agent or a bank, but it's still a pension on the other side that we're facing. Another key benefit of those peer-to-peer transactions is, like I said, the counterparty diversification. So if we're only using banks or brokers to face off with in these transactions, that's a lot of risk that we concentrate in the financial sector. As we saw during the global financial crisis in 08 and 09, if we concentrate too much activity in a single group, there are some inherent risks in that. Now, what I would say is our bank and broker partners are still a very important part of what we do. There's always going to be a role for traditional players in a lot of these transactions. What peer-to-peer allows us to do is further diversify that counterparty risk. And we evaluate those peers just like we would any other counterparty. We look at their credit worthiness, we look at their ability to deliver on the transactions that we enter into. But we also understand a pension fund. We know how it operates, and we often like the credit profile of the peer funds that we do trade with.
Well, and Chris, what I think we have here is just another example of how SWIB is an innovator in its space. I mean, we've been doing this podcast this is episode 28, so for a while here, but SWIB has been a leader in many areas since it was created in 1951. And one of those initiatives that has directly benefited your area, some of the strategies that we've been discussing here, was SWIB's collaboration with 3 other public pension funds to launch the Global Peer Financing Association 4 years ago in 2020. Can you tell us a little bit more about the GPFA?
Certainly. So the Global Peer Financing Association really grew organically out of a number of conversations that I and others would have with other pension funds at industry conferences. Over the years, we'd go once or twice a year to these conferences and have really interesting conversations around what our organizations were doing, innovations that we were looking at, challenges that we were facing. Over the years, there was a small group of us that took an interest in really advancing the conversation beyond the once or twice a year that we would get to talk when we saw each other in person. The GPFA began with a small group of us sitting down on a regular basis and figuring out how to solve for some of these peer-to-peer transactions we've been talking about. And as you might imagine, even with a small group of 4 pension funds, each one had a different challenge. For one, it was infrastructure. How do you move or settle trades without a broker to intermediate? For another, it was governance and credit evaluation. These are unfamiliar transactions and often unrated counterparties. How do you make that work within an existing governance structure? For SWIB, it was how do we structure a legal agreement with an entity that isn't a bank? This was new territory for us. So what we did is we worked collaboratively for a number of years, really, meeting regularly, ironing out issues, helping problem solve, and eventually got to a point where we actively started trading with each other. After we were actively engaged in the trading, we started sharing and talking about what we had done with other participants. And what we found is others were really interested in learning what we had done. Again, the markets that we participate in benefit from big, deep pools of liquidity and lots of participants. And so while the GPFA was originally founded to share best practice around peer-to-peer, we quickly realized that no one size fits all. There's no one path to solve this peer-to-peer issue. But B, there's lots of other opportunities for connection and knowledge sharing that the GPFA can help facilitate. And I think our members have recognized that as well. Since we launched 4 years ago, we went from 4 members to nearly 40 members that represent over 10 trillion in assets under management. And what we hear from our members as we come together is there's real value in coming together as an asset owner community. There's no bank that's trying to sell us a product or a service. It really is a safe space to ask questions, share concerns, and just get perspective on a lot of different challenges that our association members are facing. And it's interesting to see that we have members from North America, from Europe, the Middle East, Asia, and Australia, really around the world. And it's been really gratifying to see how it's grown.
It's really remarkable, Chris, that SWIB has been a leader in that area. To continue our discussion of the GPFA, we're happy to have GPFA Board Chair Rob Gooby join us on the podcast. Rob is Assistant Vice President, Collateral Management, Fixed Income and Derivatives at Healthcare of Ontario Pension Plan, with a focus on the optimization of large portfolios in excess of $100 billion for both equities and fixed income assets, utilizing global relationships, peer-to-peer, broker-dealers, and custodian banks. He also inspired Hoop's in-house collateral management software, which integrated fixed income, equities, derivatives, securities lending and borrowing, repo, and FX trading into one cohesive platform. Rob, welcome to the SWIB Podcast.
Chris, happy to be here.
So, Rob, I talked a little bit, just now about kind of the GPFA origin story. But as you kind of look back over GPFA over the last 4 years and how it's grown, can you talk a little bit about what stood out most to you as you've watched these asset managers come together and work towards the betterment of our industry?
Chris, maybe before I talk about the asset manager and the betterment of the industry, maybe I just step back a bit on how we evolved and some of the work that was done to get us here. And to be quite frank, one of the surprising factor was the growth of the GPFA. We went from 4 members to approximately 40, but that wasn't possible without the board members. As a board, you're a board member, I'm a board member, we have others as well. But the big commitment there was every Wednesday we met for the last 4.5 years, and we created a team dynamic, a culture where we have trust, openness, and commitment. That in itself really and truly set the tone. And with that in mind, the community itself, it transcended the entire community, which today nearing 40 members. And as that happened, we inspired trust and really and truly a friendship among the buy-side community and an openness and awareness to speak to each other and learn from each other, because everyone is at different stages in their journey. And the conversation changed quite a bit. In the first 4 years, the conversation was really surrounded around who is your agent lender, what is your utilization, what is your collateral schedule, that type of stuff. Today, the conversation is a lot different. It is about balance sheet and liquidity management, collateral management. It's about considering, is this a function that you insource or outsource? Is this a function that is alpha generating revenue, or is it a function of providing safety and soundness to your fund? The conversation is a lot different, Chris. I love to explore more if you want to chat more about this part.
Yeah, I think it's important. And I think, SWIB is an organization, and me personally, I've learned a lot from the other members of the association. I've gotten a ton of value out of the conversations that have been sparked through the GPFA. And SWIB as an organization has benefited from those connections, from kind of expanding our counterparty roster, expanding the folks that we trade and transact with. When you think about kind of the impacts on the industry as a whole, how do you think GPFA has helped highlight or facilitate some of those impacts?
So what I would say, when we think about sec lending, that's where we started really 10 years ago. And in the last 4 years, GPFA has been formed. And sec lending used to be an activity that was really seen as a back office activity, an afterthought. Today is an activity that is there's another club in the bag. And there's multiple clubs you have to use to really and truly have a good game. And what I mean by that is not just sec lending. We took the sec lending activity and bring it into a total fund, centralized balance sheet management function. And not just the Canadian pension plans, but we've seen it throughout the globe, where members in Australia is creating a centralized function. Members in the Middle East is creating a centralized function. And we can talk more about the function. The US as well, the US pension plans were, I think, in my opinion, was behind, and now they are getting up to speed and they are doing pretty well and really and truly centralizing the function. Like this conversation today, we probably wouldn't have had a conversation like this today 4 years ago. And then you would see that you guys use derivatives, you use sec lending, you use repo. I'm not sure if you're using paper, but there's so much short-end tools that is available to us now that is important for pension plans when they're considering the liquidity management.
I agree. It's really been kind of a shared evolution of that treasury role, right, within our various organizations. And it looks a little bit differently, I think, across the membership. It looks different at SWIB than it does at Hoop. But what we've kind of shared in this journey is this constant evolution towards more centralization, more internalization, and more collaboration across market participants that are fairly well aligned in terms of what we're trying to accomplish in these different treasury or different financing transactions.
And I think, Chris, just maybe we centralization, but the key really is with all of this, as a group, what we're trying to do is we're trying to really and truly show up or get liquidity and to find that liquidity. There's liquidity in the market. And the truth is the liquidity will maybe at some time trapped at custodian banks where they probably don't lend out as much GC as they used to because of the different regulations and the cost of lending GC. And those type of activities, if it can happen where one peer borrowed GC equity from another peer, I think as an industry overall, we could reduce the cost and it's going to be beneficial to our members.
Yeah, and when you say GC, we're talking about general collateral, which is, kind of the cheapest and easiest to borrow securities that are out there. They really serve as kind of the lifeblood of a lot of financial markets and allow more liquidity to move between entities. We've talked a little bit about the kind of the journey. We've talked a little bit about where we've come from. As you look forward, what sorts of trends are you seeing in different areas, and what do you hope the GPFA looks like in maybe 5 or 10 years?
That's a good question, Chris. When we meet every Wednesday, I kind of say we make it up as we go. And what I mean by that is it is constant change. We have to be thoughtful about those changes, and we have to be thoughtful of the team. The team is a volunteer team, so we volunteer our time. And when I think about creating what does the GPFA look 5 years from now, 2 years from now, 4 years from now, is the way we establish in the structure right now. We have the board, and then we created country heads, as a matter of fact, co-heads. So the idea there is to have a co-head in the US, co-heads in the Middle East, Australia, Singapore, Canada. So we have 5 co-heads. In my opinion, on what I could see, I see 10 new volunteers. And after that, I'm hoping to have, I wish we already established, working groups. And I don't want just the GPFA just to be about sec lending or financing, but it's about really and truly saving in all different areas, because pension plans are facing the same activities and in multiple disciplines. So when I think about a discipline, we created the legal working group. And Trevor is doing a fantastic job. I think there's about 25 lawyers meet on a monthly basis. We creating the peer-to-peer group that is being led by Matt from Norges, and it's just forming, and we're just going to see where that go from there. We created a technology and operation group. Again, all this businesses require tech, it require operation, and so we want to create different groups in different disciplines that support the business. And quite frankly, support investing overall within the financing world on the buy side. And if you think about this, and if you step back for a second, the banks, they do not offer as much balance sheet as they used to in the past. And the balance sheet does exist in the buy side. And we got to find a way to access that balance sheet. And hopefully with time, we could come up with solutions that would make it easy for peers to connect with other peers and potentially do trades at some point in the future.
Yeah, because it's that critical mass, right? That's really important to our industry and really important to these sorts of transactions of the buy side trading with each other, but the buy side trading with the market in general. If you don't have that critical mass of participants, people that understand the risks, the returns, you're not going to get as many participants, and that's going to lower liquidity for everybody. And I think that's one of the challenges that GPFA is fighting against, and helping to kind of shine light on this market and help folks understand how it works and what the real benefits are that a lot of asset managers can unlock.
I mean, that is the truth. Liquidity is everything. I mean, we went through the 2008 crisis. We went through March 2020. And I would say liquidity means different things to different institutions at the same time. One institution might have a lot of treasuries on the balance sheet, but do not have enough repo lines to turn those treasuries into cash. Others might have a lot of repo agreements and may not have the asset to repo and to get those securities and turn it into cash. So there is a network effect, and there's a need for beneficial owners or for market participants to find each other so we could find that fluidity in exchanging collateral and getting it into the user hands at the right time. And that's what it really is. And in order to do that, you need technology. You need to have your legal agreements. You need to have operation capability. You need to have your management support. And you need to have risk management tools and best practices in place. And I think the GPFA is bringing that to light and bringing those 5 topics I just kind of bring out here.
Yeah, it's been interesting to me to watch it evolve. When you and I and the other two funds started the GPFA a few years ago, it was just some securities finance folks kind of in the trenches looking to share this information with the market. And it's evolved to this interconnected association of organizations where my legal team or compliance team has a group of legal and compliance folks that they can call around the globe. Our operations team has a group of operations folks that they can call around the globe that are facing similar challenges, bounce ideas off of, collaborate on solutions. And it's really been a huge benefit, I think, to bring these different parts of our organizations together, not just focused on peer-to-peer trading or financing, but really kind of across the organizations.
So, Chris, and I agree with you. When we initially started, the idea was peer-to-peer, but we quickly realized that not all buy side is ready to do peer-to-peer trading because you need to have an infrastructure in place. You need to have some basics in the legal documents, as I mentioned earlier. You need to have the operation support, as I mentioned earlier as well. And you need to have systems in place to capture those transactions. And we quickly pivoted to really truly educating the industry. And as we educate, I think with time, that education would get us a level the playing field. And as we level the playing field, it would increase more liquidity in the marketplace. And I think overall, we could be a safer place to operate.
Well, Rob, this has been great. Any final thoughts you want to share with us about the GPFA or where we're going?
The one thing I would say in terms of final thoughts, we see this business or the sec lending function, the collateral management function evolved into becoming more of a total fund view, a total liquidity management, leverage management. With that shift, we are seeing the role is becoming more important. It moved away actually from the back office into the front office, and is in a lot of organizations globally, it has a seat in the asset allocation at the top of the fund level. So really good journey so far. And if you think about it, when you're constructing your portfolio, you have to consider the liquidity of the assets you're buying and the ability to turn your assets into cash in times of stress. And I think that's one of the real essence of what we're trying to teach and trying to share among the membership. You create your portfolio, you think about your construction, you're going to use derivatives, you're going to use cash instrument. It will have an impact on your decisions and how you manage liquidity. And I think that is what we really want to drive home as an industry and within our membership, share that type of knowledge.
Well, Chris and Rob, this has been a fascinating discussion today. Thank you both for joining us on the podcast.
It's my pleasure, and I would love to connect again. And Chris, I'm looking forward to seeing you soon in Toronto.
Sounds great. Thanks a lot.
And thank you to all our listeners for checking out this episode of the SWIB Podcast.
The SWIB Podcast is brought to you by the State of Wisconsin Investment Board and produced by PodCamp Media. Branded podcast production for businesses, podcampmedia.com. Our editor for this episode is Matt Covarrubias.
Thanks again for listening. I'm Chris Preisler.
And I'm Dusty Weiss.